Hi, I'm Larry Gaines. Here at PowerCycleTrading.com, I share what I've learned from my 3+ decade career trading securities professionally. And in this video, I'm going to show you how weekly options work versus monthly options. Now, when trading options, the most important option factor is to understand the concept of time and the impact that it has on price. So that's really what weekly versus monthly options really come down to. If a security is optionable, it will always have monthly options, which are standard, but not necessarily weekly options. Now, monthly options always will expire on the third Friday of the month. Monthly option time decay, 30 days out, that starts out about 3% each day and then accelerates the closer you get to expiration. Now, a new weekly option series, though, is introduced every Thursday up to 39 days in advance, and each new series expires 1 week later on Friday. Now, weekly options will always have the same settlement times as a normal monthly option, and those are usually a PM settlement. The weekly time decay, though, of an option is very extreme, or what I call turbo time decay, because it's approximately about 12% each and every day. So it's very, very accelerated. Now, weekly options and monthly options are really similar, and the main difference, though, besides a few settlement times for different products, is the amount of time until expiration. Now, option sellers refrain from selling options with more than like 100 days until expiration, because the theta decay, our time decay, has less of an effect with the more time until expiration. Now, conversely, though, as expiration draws near, out-of-the-money option sellers will rapidly lose, or options will rapidly lose value due to that theta decay or time decay, because the options will either expire worthless or with intrinsic value. So this is when the option sellers really choose to sell. And weekly options are going to provide you a lot more flexibility and time frames to choose from when deploying different option trading strategies. Now, basically, there are two different strategies traders like to use with options. So either buying or selling. Now, buying options involves, risking a small amount of money to potentially make a lot, and selling options involves risking a larger amount of money to make hopefully, a little. Now, the difference is that when you're selling options, particularly out of the money options, because they're going to give you a higher probability of, expiring worthless, that is why you're getting, kind of what we call a negative risk ratio. So you're going to be a seller of options because the probabilities are more in your favor that the options will expire worthless when selling out of the money. It's the age-old concept of let's sell high and buy low, except you can't buy low if there's nothing to buy when an option expires with a value of 0. So this is part of the appeal of selling options. So as time passes and expiration draws near, out-of-the-money option contracts will theoretically decrease in value due to that time decay element. And the Chicago Board of Exchange realized that traders like to sell and buy options based solely on the amount of time remaining until expiration. So weekly options were created, and there are now option expirations for most stocks every single Friday. Now, this time chart shows you kind of a time graph of decay. So if you look here, this is like looking at 120 days to 90 days out. And you'll see this slope, this is the time value and how it decays, is very flat. Now, as you get closer to expiration, you can see from 30 days out here, it really starts to fall off and accelerate. So, options are a decaying asset and will go to 0 at expiration. So you can see how that time starts to really trail off. And so this is a, longer term option series. Now, when you go to weekly, it's very accelerated. So this is the time decay graph or curve of a weekly option series. And you can see how accelerated that curve gets. So it really escalates and gets extremely steep as far as the sell-off and time decay. And this is about 12% each and every day until you get to 0. So that's a very accelerated time decay, and that's why the weekly options are a great series to buy, either to be buying cheap options because the little time left, or to sell time decay. So this is an option series, and this is for Amazon. So this is the big takeaway that you're going to notice. So if you look here, Amazon on this slide was trading at $766, and here are all the different strikes. So we're looking at the money strike here of 765. So this is a weekly option. See, it's got 7 days right here where my arrow is till expiration. If you look at the price there at 765, that at the money, you can see that the call option here, the bid ask is 655, the ask is 680. So let's say you bought this at 680, so that would be paying $680 for one option contract. Now you can see that the theta decay, that's the time decay of this particular option, is 39 cents a day. So If you were to come in a day later and you paid $6.80 for this and you come back the next day and it had not changed in price, this price would now be $6.41. But the big thing here is if you look at the price value, 765 short strike, it's going for $6.80. Now, if we go out further out in time, though, you're going to see this option really gets very expensive, and that's because of the time portion of that option that's in the series. So here again is Amazon, again, trading at 765 right here where my arrow is. But this has, you can see right here where my arrow is, 42 days to expiration. Now, if you come over to the strike prices here, go down to that 765 strike, come over here, you can see that that call is $19.60 is the asking price. So that would be $1,960 for one option contract. So you can see it's so much more expensive when you're buying further out in time because you're paying for that extra time decay. But the time decay right here is only 22 cents or $22 per day. So big difference, 765, 42 days out, that option is going to be priced at $19.60 per option contract, which would be for one contract $1,960, versus if you bought a weekly option 7 days to expiration, it's only going to be for $680. So looking back here at 765 strike, 7 days to expiration, it's only $6.80 or $680 per option contract. So I hope this video was informative and helpful as far as showing you the difference between a weekly option versus the monthly option and the benefits and advantages, of a weekly versus a monthly option. At PowerCycleTrading.com, I've put together a free toolkit with some of the most important information for option traders. You can go right here to get that free toolkit. Just click on Get Toolkit at PowerCycleTrading.com, and I'll see you there.